Good morning all and welcome to Direct from the Desk. It's Sunday morning. I've just finished writing the weekend note. We're in my home office at the moment. We've now got the whole team working remotely. The back end of last week I started working remotely. I'm going to continue to work remotely. From here we've got my wife's at home doing a similar thing. The kids are at home. So that brings itself with it a number of challenges, etc. But the whole nation's going through this. And I think it's what we need to do to come to grips with this virus and overcome the spread that's increasing. Not as rapidly as perhaps what we're seeing in the US, but it's still, the numbers here in Australia are reasonably frightening. In this quick video update, I just wanted to give you an overview of sort of our market views at the moment and some of our portfolio positioning. And I will continue to give you more regular updates from a video format in the coming weeks. I've been a little bit slack in terms of video updates in the last few weeks. We've been hugely busy on the desk. It's been a very volatile time in the market. We run different parts of our business and they've all been incredibly busy over that period. So I apologise for not giving you more regular updates, but that should increase over the coming weeks. In terms of the markets, I've written this morning just around some stats around market declines and the subsequent recoveries in markets. There's a large pool of data to source from. Now, while this market decline has been the most aggressive that I've seen, it's very similar to what, it's more akin to what played out in the '87 crash as opposed to the GFC. We've had such an aggressive route in the market. And when you have such an aggressive route in the market, that implies that we'll also have a pretty steep recovery. That's what played out in '87, over and above what played out in terms of the GFC. So our best guess at this stage is that the really rapid decline then opens up to a really rapid recovery. Looking more short term, we've obviously had the decline of about 38% in the ASX. We've rallied off the back of that, then we sold off again on Friday afternoon. So we're not discounting the chance that the market goes down and retests the lows. That's a pretty standard way for markets to put in a low. So you get a big rout, you get a bounce, and then you get a retest of those lows before a sustained recovery plays out. Markets do bottom when news is pretty negative. I think that's a really important thing to remember. So the news headlines when the market is going to bottom is going to be very negative. And I think we're seeing that now. There's a lot of negativity in the press about the virus and the spread of the virus, etc. But stocks price the future, and our modelling suggests that in mid-April the US is going to be over their peak new case increases on a daily basis. Australia is going to be in that seat somewhere sort of around the start of on the first week of May. So markets will start to look through it and to the other side. In terms of our own portfolios, we didn't have as much cash as we would have liked to going into this correction. I put my hand up and obviously concede that fact. What we're focusing on now is a improvement in the quality of our portfolios and improving the flexibility we've got around them. So in our platinum portfolio on Friday, we did a small change. We trimmed Macquarie. Not significant at all, but it speaks to what we're likely to do going forward. So Macquarie, we had 8% in the portfolio of that holding. We also had, we've got other market-linked exposures. Macquarie's a really high beta market-linked exposure. We've also got other high beta market-linked exposures in there in terms of Magellan as well as Janus Henderson. So we're pretty, we're overweight the financial space at the moment, the market-linked space at the moment, which whilst there's going to be positive for a recovery, and it was positive for the portfolio last week, I think we need to be trimming that area of the market from a risk perspective. The other edgier parts of our portfolio, we've got NRW Holdings, NWH and Emeco EHL. These are two higher beta plays. When I talk about high beta plays, I mean stocks that move more than the market does. So on rallies, on positive days as we saw last week, these things rallied really hard, and on sell-offs, these things sell off typically pretty hard. They're high edgy, high beta stocks in the portfolio. So I think we've got one too many of those at this stage. We've got two reasonably sized positions in the banks. We're likely to trim one of those. I wrote this morning about the IT space in the portfolio. Last week was a really good example of what can play out in the IT space. We've been pretty negative on those high valuation areas of the market in recent times from a valuation standpoint. You think about Afterpay. Afterpay's dropped from $40 down to $8, but last week it rallied over 50%. So that area of the market will bounce very hard when it bounces, and I think that's what we're sort of lacking in the portfolio. I think Xero is a key pick in that space. It's a high quality business. Altium is another one that I'm really keen on to add to the portfolio. So this is a really strong opportunity. I write about it in this morning's note, just around setting a portfolio for the coming years. We're not traders at Market Matters. We call ourselves active investors. Well, we're all about trying to pick sectors that we want to be exposed to and the stocks within those sectors that'll give us best bang for buck. So that's what we're going to be concentrating on over the coming weeks, is improving the quality of the portfolio, tweaking some of the sector allocations, etc. And I touch on that in the weekend note. The income portfolio had an interesting week, and there's just one thing I want to call out in terms of the income portfolio. The hybrid market we've had a lot of questions through around the hybrid market, and I've tried to answer those during the week, so they may not appear in the Monday report. I've tried to answer those in real time, given the movements in this market over the last week or so. That the hybrid market, you can look at an index called the Selective Hybrid Index. That actually rallied 9% last week, and we've seen a lot of liquidations or selling in that space to fund other things. It's not the most liquid market, so you get amplified moves, etc. But I think that market, into weakness, is representing some pretty compelling value there. I wrote about it on the Wednesday report as well as the week before. So keep an eye on the hybrid space. There's a lot that are trading around $90 that are offering yield to first call 7-8%, etc. So for me, that's pretty attractive. One thing in that space that did change during the week in the US. The US Federal Reserve introduced some support for corporate bond market over in the US. I was actually talking to a good mate who runs a bond desk for one of the Australian banks, and he was simply commenting that the market doesn't seem to be working at the moment. There's a lot of dislocation around the place, and that there's a lack of liquidity, and that's amplifying moves, etc. So I think what the Federal Reserve did last week, including corporate debt into their stack of things they're going to support, was a real positive. And at the back end of last week, we saw that the corporate debt market settle a little bit, and I think that's really key for the equity standpoint. So the bond markets need to settle down, and they need to settle down with some Fed help, and they've just got that at the back end of last week. So, I wrote this morning just around the idea around volatility, and that volatility has really peaked. I think we've seen peak volatility in this market, and I think over time the volatility will start to dissipate from this market. Whether or not we go and retest the lows, I don't think is the more, I don't know if we go and retest the lows. I think there's a good chance that we will, but ultimately that will be a really strong set up a really strong buying opportunity moving forward. At the back end of last week, the Australian market fell away 5% on Friday's session. It was after a very good week in terms of stocks, so I wouldn't read too much into that. Friday afternoon, 2 days is a very long time in terms of the news cycle. We've also seen some pretty horrific Mondays over the last few weeks, where US futures have opened limit down, and then we've seen a raft of selling hit the ASX. So from a shorter term perspective, it's reasonable that traders were selling out on Friday afternoon. We actually saw the same phenomenon play out in the US market on Friday, where the actual, we had a really good week in the US, and we had a really good Friday session in the US where stocks opened lower, but they ground up throughout the day until just the last short while in the market. The market got hit really hard into the weekend. A similar theme playing out this concern around what plays out over the weekend. So look, I think the volatility, as I say, I'll wrap up here, but the volatility I think is starting to decline. It's all about picking now the sectors we want to be in, and the stocks within those sectors, improving the quality of our portfolios, which I think is going to be key moving forward. So I'll give you another update in the next couple of days. As always, if you've got questions, please send them through to info@marketmatters.com.au, and we'll get to those. But I hope you're all staying safe, healthy, and enjoying a bit of time with the family. Bye for now.